The most powerful and consistent signal in market psychology is the cyclical swing between greed and fear. In cryptocurrency, a market uniquely driven by sentiment, this swing is amplified to an extreme degree. The Fear and Greed Index is not a perfect predictor, but it is a remarkably accurate barometer of the crowd's emotional temperature. When this index plummets to levels between 10 and 15, as it has recently, it is signaling something critical. Pervasive, almost paralyzing fear has gripped the majority of market participants. This is not casual worry or mild concern. This is the blood in the streets sentiment that legendary investors like Warren Buffett and Sir John Templeton famously cited as the ultimate buy signal. Let's unpack why this is so significant. Market bottoms are not formed when everyone is calmly discussing value. They are formed in a state of panic, capitulation, and exhaustion. The drop to such extreme fear readings signifies that the final wave of weak-handed investors is selling. These are the individuals who bought near the top on hype, who over-leveraged, and who operate purely on emotion. Their exit is a necessary cleansing process. It transfers assets from impatient, emotional hands into hands of patient, strategic capital at deeply discounted prices. This is the very mechanism that creates a solid foundation for the next upward move. The selling pressure from this group finally exhausts itself, leaving little downward momentum left. Examining previous instances where the Fear and Greed Index hit similar lows provides a compelling blueprint. Look at the major dips within this very bull cycle, the correction in April 2025 and the summer 2024 pullback. Both were preceded by or coincided with sharp plunges in this index into the extreme fear zone. On each occasion, while it felt like the market was in free fall, it was actually setting a significant local bottom from which a powerful rally emerged. This is the contrarian playbook in action. The moment of maximum pain for the crowd is the moment of maximum opportunity for the disciplined investor. This phenomenon works because fear is a blinding emotion. It causes investors to extrapolate current losses infinitely into the future. When Bitcoin is down 29%, the fearful mind convinces itself it will go down 50%, then 70%, replaying the nightmares of previous bear markets. This leads to a wholesale dismissal of underlying fundamentals, technical support levels, and macro tailwinds. The crowd becomes myopic, seeing only red candles and losses. This uniform pessimism is ironically what makes it unsustainable. When nearly everyone who is prone to selling has already sold, the only remaining action is a buy. Furthermore, this extreme fear often creates a stark and exploitable divergence from on-chain and technical reality. While sentiment is screaming crash, the charts might be showing a hidden strength, a bullish divergence on the RSI where price makes a lower low but momentum indicator makes a higher low, or a successful hold of a long-term logarithmic support band. The panic obscures these subtler, more constructive signals. The contrarian's job is to look past the screaming headlines and social media despair to see if the price action is actually confirming the narrative of irreversible doom. Frequently it is not. Therefore, treating the Fear and Greed Index as a contrarian buy indicator is not about reckless falling knife trading. It is a strategic framework for accumulation. It is the signal to begin methodically scaling into positions, to rebalance portfolios, and to deploy dry powder that was reserved for this exact emotional environment. It is the recognition that the market is offering a discount not based on degraded fundamentals, but on degraded sentiment. The underlying thesis for Bitcoin and select crypto assets, digital scarcity, institutional adoption, monetary devaluation hedges, does not vanish because the index hits 10. If anything, those fundamentals are often strengthened during these periods as networks prove their resilience and development continues unabated. In essence, the extreme fear signal is a lighthouse in a storm of emotional volatility. It doesn't pinpoint the exact minute of the low, but it illuminates the general vicinity of a major turning point. It tells the astute observer that the conditions for a reversal are maturing, that the selling is moving from rational to irrational, and that the emotional pendulum, having swung so far towards despair, is now primed to begin its long journey back towards equilibrium, and eventually towards greed. Ignoring this signal means being swept up in the very crowd psychology that creates the opportunity in the first place. Heeding it is the first step in transcending reactive emotion and engaging in proactive, disciplined strategy. The visceral, gut-wrenching feeling of watching a portfolio hemorrhage value is an experience no investor ever forgets. In the volatile crucible of cryptocurrency, where 24/7 markets and leveraged positions amplify every move, a 29% drawdown from an all-time high feels apocalyptic. The psychological toll is immense. It triggers a cascade of primal fears, the fear of total loss, the fear of being wrong, and the fear that this time is different, that the game has irrevocably changed and the bull market is dead. However, the single most powerful antidote to this emotional toxicity is historical context. Objectively analyzing price action against the very recent past reveals a crucial grounding truth. This decline, while severe, is not an anomaly. It is a standard, albeit painful, feature of the ongoing bull market architecture. To understand this, we must move beyond the absolute number, down 29%, and examine it within the framework of the current cycle's volatility profile. This isn't 2017 or 2021. We are in a new regime defined by institutional capital flows via ETF, sophisticated derivatives markets, and a different macroeconomic backdrop. Yet, even within this new paradigm, the market has established its own rhythm of advance and retreat. Let's examine the evidence directly from this cycle. The Cone 2025 correction. From its peak in late 2024 to its trough in early 2025, Bitcoin experienced a drawdown exceeding 31%. The charts from that period show a nearly identical pattern of panic, a cascade of liquidations, a flood of bearish prophecies, and a pervasive belief that the rally was over. That correction, which now sits comfortably in the rearview mirror as a mere dip on the long-term chart, was more severe in percentage terms than the current decline. The summer 2024 pullback, following the initial ETF-driven euphoria, the market consolidated and then sold off sharply in the summer of 2024. That drawdown measured approximately 33%. Again, the sentiment was dire, the headlines were grim, and the narrative shifted to a prolonged crypto winter. Yet that decline proved to be a magnificent buying opportunity that fueled the next leg up to new highs. This is the critical perspective. We are currently navigating a downturn that is, by the measurable metric of percentage loss, less extreme than two other major corrections that occurred within the last 18 months. Each of those prior episodes felt like the end in the moment, but were ultimately revealed to be necessary consolidation and leverage resetting events within a larger bullish trend. The market has a habit of testing the conviction of its participants, and these deep retracements are its most effective stress test. Why do these violent corrections occur? They are multifaceted in origin but singular in purpose, to reset over-leveraged conditions and shake out speculative excess. Multiple Fed officials have already begun telegraphing that discussions around the next phase, potentially even renewed key, are on the table for 2026. The market is a forward-looking machine, and the simple end of constriction is a powerful bullish signal. It tells institutional allocators that the period of maximum liquidity withdrawal is over, freeing them to deploy capital into higher risk, higher reward opportunities like cryptocurrency without the fear of the Fed actively pulling the rug from beneath them. Its next major leg higher will likely not be triggered by a new blockchain upgrade or a single regulatory approval, but by this broader macro capital migration. The setup is analogous to a dammed river. The Fed is about to stop building the dam, ending QT. A massive adjacent reservoir is overflowing AI stock profits, and the floodgates within the crypto valley itself straining at their hinges. When they open, the resulting surge of liquidity will be the fundamental fuel that drives the next phase of the bull market, lifting Bitcoin, Ethereum, and select altcoins on a tide of capital that has nowhere else with such a compelling risk-reward profile to go. This is the quiet, powerful narrative building beneath the surface of the current panic. In the chaotic narrative of a market crash where every news headline screams doom and social media sentiment plummets, price charts offer a form of objective truth. They are the ledger of collective human action, of fear, greed, panic, and calculation, stripped of its emotional packaging. Right now, despite the overwhelming narrative of collapse, this objective ledger is etching a compelling story of capitulation and structural support. Across major assets, we are witnessing the successful, albeit violent, test of critical technical levels that have historically acted as the final line of defense before a trend reversal. This confluence of signals does not guarantee the exact low is in, but it powerfully suggests that a bottoming process is actively underway. The most significant action has been in Bitcoin, the market's bedrock. The recent plunge was not a random descent. It was a targeted flush. The price aggressively sought out and liquidated two crucial support zones. First was the psychological and technical support around $92,000, an area that had previously acted as a springboard. More importantly, the decline extended into the $89,000, $89,800 range. This zone is far from arbitrary. It represents a golden pocket Fibonacci retracement level, often between the 0.618 and 0.625 fib of the entire rally from the last major cycle low. For algorithmic traders and institutional desks, these Fibonacci levels are not mystical lines, but self-fulfilling zones of heightened interest whereby orders cluster and liquidity pools form. The fact that the market precisely wicked into this zone before snapping back with furious velocity is a classic signature of a liquidation-driven capitulation low. The market didn't just slowly drift through this level. It spiked into it, triggering the final cascade of over-leveraged long positions, and then sharply rejected. This is the chart equivalent of a controlled demolition, using extreme volatility to purge the system of its weakest speculative excess, clearing the path for a new foundation. This pattern of precision is mirrored in Ethereum. ETH price action located and bounced from its own key Fibonacci retracement support near $29.50. This golden pocket level for Ethereum served as a magnet for price, drawing it in and providing a clear platform for a rebound. The validation of this level is further strengthened by the activation of a daily chart by Signal on its key momentum oscillator. This tells us that the bounce is not just a random dead cat bounce, but is being confirmed by a shift in underlying momentum, suggesting the selling exhaustion at that level was real and meaningful. The altcoin market, often the most brutalized sector, is also displaying crucial signs of stabilization. Examining the Total 3 index, which tracks the total market cap of all cryptocurrencies excluding Bitcoin and Ethereum, reveals a vital technical structure. A trend line of higher lows that has held since the 2023 bear market bottom. Despite extreme fear, this broader altcoin index has, so far, respected this long-term ascending support. The halving was a clear, singular catalyst around which this retail narrative could coalesce. Today, the introduction of Spot ETF in January 2024 has created a powerful, persistent, and structurally different source of demand. Institutions like BlackRock, Fidelity, and Van Eeks do not trade based on four-year cycles or Twitter sentiment. They allocate based on macroeconomic imperatives, portfolio strategy, and regulatory windows. Their buying is methodical, often price-insensitive over the short term, and driven by a multi-decade thesis on digital assets as a new asset class. This creates a constant underlying bid for Bitcoin that simply did not exist in prior cycles. It fundamentally alters the supply-demand equation, damping the violent downside volatility of past bear markets and potentially elongating and flattening the bull market phases. The sell-everything mentality of a post-top retail exodus now runs into a wall of strategic, long-only institutional holders. This new reality shatters two major pillars of old-cycle analysis. First, the obsession with fractals and precise historical comparisons. Many are currently pointing to the Bitcoin chart from November 2021, a double top formation, and declaring an identical top is in for 2025. This analysis is flawed because it ignores context. The 2021 market was a purely retail and leveraged crypto-native speculator frenzy, peaking amidst a global liquidity bubble. The 2024-25 rally has been institutionally led with a radically different liquidity backdrop, initially high rates QT. The players in the fuel are different. Expecting an identical price pattern is like expecting a diesel truck and a race car to have the same acceleration curve. Second, it invalidates the predictive power of the halving event itself as the sole cyclical trigger. The April 2024 halving occurred, yet the most explosive price appreciation preceded it, driven by ETF approval anticipation and flows. The post-halving period has so far been characterized by consolidation and correction, not the immediate, explosive uptrend the old model promised. This is because the supply shock narrative is now competing with and being mediated by the massive daily flow data from ETF, which can eclipse minor issuance by orders of magnitude on big inflow day. The halving is now one factor among many in a more complex financial ecosystem, not the undisputed central clock. Furthermore, this institutional hegemony changes how we must analyze market phases. Classic indicators like the Bitcoin dominance chart now tell a new story. In past cycles, a falling Bitcoin dominance, altcoin season, was a reliable late bull market phenomenon, followed by a sharp reversal as capital fled back to BTC during a crash. Now, we see a scenario where Bitcoin dominance has been in a steady downtrend, a bullish sign for alts, even during a major correction. This suggests institutional BTC buying via ETH provides a stable base, allowing speculative capital to rotate within the crypto ecosystem into alts with more confidence, rather than fleeing the asset class entirely at the first sign of trouble. The market's internal dynamics have become more nuanced and interlinked. So, what replaces the old cycle model? The new framework must be built on liquidity flows, on-chain data, and macro correlation. The primary questions are no longer, where are we in the 4-year cycle? But, what are the daily, weekly ETF net flows? This is the single most important new dataset representing real-world institutional demand. What is the macro liquidity outlook? As explored earlier, the Fed's balance sheet policy and global dollar strength, DXY, are now more critical to crypto than any halving countdown. Understanding crypto's position within the broader universe of risk assets, e.g. vs. tech stocks, gold is essential. What do on-chain metrics for long-term holders, LTH? The behavior of entities holding coins for over 155 days, increasingly institutions and committed investors, provides a clearer signal of conviction than broad retail sentiment. Embracing this new paradigm requires humility and adaptability. It means acknowledging that the comforting certainty of historical cycles has been replaced by the complex, but potentially more stable reality of institutional finance. The market is no longer a wild, predictable pendulum swing between retail greed and fear. It is becoming a more mature, integrated, and liquidity-driven financial market. This doesn't eliminate volatility or cycles, but it fundamentally changes their character, amplitude, and drivers. The investor who clings to the 2017 or 2021 playbook risks being strategically left behind, selling too early in a structurally supported market, or waiting for a mythical, cyclical bottom that may never arrive with the same ferocity. The future belongs to those who analyze the signals of today, ETF flows, macro liquidity, and institutional on-chain movement, not the echoes of yesterday's retail friends.